Welcome to vTalkInsight Allocator's Lens Daily for January 12th, 2026. Across assets, we have a powerful mix of strong U.S. growth, mixed labor signals, and very low volatility, all while policy moves in housing, trade, and defense reshape the medium term. Let's start with how that backdrop is playing out in global equities. In equities, optimism is being driven by a powerful earnings story in technology and housing, but valuations and concentration risk are becoming harder to ignore. Chipmaker TSMC just reported revenue growth of about 20% year-on-year, beating expectations on the back of intense demand for GPUs and data center chips linked to artificial intelligence investment. That strength has spilled over into European semiconductor equipment makers like ASML and other suppliers, reinforcing the idea of a robust, global AI hardware cycle that investors are still keen to back. Even so, the equity story is no longer just about a handful of mega-cap platforms. Market leadership is gradually widening to banks, industrials, energy, and parts of healthcare, and the Russell 2000 has outpaced major benchmarks at the start of the year, signaling renewed appetite for smaller companies. Small and mid caps still trade at notable discounts to their own long-term price-to-earnings ratios, which helps explain why investors are exploring rotation away from the most crowded large-cap growth names. Strength in the bank sector ETF and solid year-to-date gains for major U.S. banks underline that financials are now a meaningful part of the risk-on tone. The flip side is valuation and concentration risk, especially in semiconductors. Chip and memory stocks have run so far that sector valuations are now being compared to levels seen around the year 2000, which encourages more caution about how much good news is already embedded in prices. Some large investors are trimming exposure to big winners, such as major internet platforms, not because they have lost conviction, but to stop position sizes and single-name risk from becoming unmanageable. At the index level, S&P 500 earnings are expected to grow by roughly 10% this year, with contributions broadening from mega-cap tech into sectors like energy, industrials, materials, and financials, which supports the case for U.S. equities over many international markets. Macro data largely backs that earnings story, but it is not uniform. Recent estimates put fourth quarter U.S. growth above 5%, and consumer spending has re-accelerated, yet most of the incremental spending is coming from higher-income households, which now account for well over half of total consumption. At the same time, job creation has slowed sharply relative to earlier in the year. Manufacturing employment fell in 2025, and annual payroll growth is the weakest since 2020, even as wage growth around 3.8% year-on-year remains resilient. Within equities, the AI narrative itself is also evolving, with more focus on companies using AI to improve margins and efficiency, and a recognition that very aggressive infrastructure spending, such as multi-billion-dollar cash burn at some AI ventures, may not translate into near-term profitability. All of that leaves equities highly sensitive to the rates backdrop. There are warnings that, from here, rising yields could matter more for valuations than low earnings expectations do, especially given today's rich multiples and the very tight clustering of returns in a small group of dominant firms. Implied volatility on U.S. equities remains in the mid-teens, and realized moves have been modest, even though markets face ongoing labor data noise and a pending Supreme Court decision on tariffs. For a multi-asset allocator, the key equity questions now are whether small caps and cyclicals can sustain their early strength, how long AI-linked semiconductors can deliver on lofty expectations, and how quickly equity multiples react if incoming data force markets to rethink the timing or scale of future rate cuts. Turning to rates, the striking feature is how little nominal yields have moved despite a packed risk calendar. 10-year treasuries have traded in an unusually tight range for weeks, and volatility gauges for the treasury market sit near their lows, even as investors brace for key labor releases and legal decisions on tariffs. This stability suggests a strong consensus that the Federal Reserve is on hold near term, but also raises the risk that markets may be underpricing the potential for sudden repricing if data or policy surprises break that calm. Current pricing points to roughly 2 Fed cuts later this year, with almost no chance given to a January move after a run of cleaner inflation and activity numbers. Policymakers have already delivered front-loaded easing to address labor market concerns and are now signaling a preference to pause and wait for more clarity. The latest labor readings are mixed. Payrolls grew only about 50,000 with downward revisions. Manufacturing employment is under pressure, and job gains are highly concentrated in healthcare and education. Yet the unemployment rate has surprised slightly on the low side, and wages are still rising around 3.8% year-on-year. That combination fits a slow, cooling narrative rather than an outright downturn, and it leaves open the possibility that front-end rates are mispriced by something like 0.5 percentage point if markets have been too quick to assume an extended easing cycle. Structural fiscal dynamics add another layer. Across major economies, average deficits around 6% of GDP and debt levels near 100% of GDP are described as unsustainable, with discussion of an extra $500 to $600 billion of U.S. defense spending still not fully reflected in bond markets. Even potential court-ordered tariff refunds, which might add less than 1% of GDP to the deficit over a couple of years, reinforce concerns that fiscal policy is leaning against the Fed's efforts to normalize its balance sheet. One implication is that bond yields may stay higher than in the prior cycle, and that duration may no longer offer the same diversification during equity drawdowns, even though many investors still see value in global bonds, especially via roll-down and steepening trades in the 5 to 10-year part of the U.S. curve. Housing policy is also feeding back into rates. Fannie Mae and Freddie Mac have been directed to buy up to $200 billion of mortgage-backed securities, partially offsetting the Fed's ongoing runoff and helping to push mortgage rates below 6%, their lowest in nearly 3 years. Market participants increasingly describe this as a form of mortgage quantitative easing led by the Treasury, even though the program is small relative to the multi-trillion-dollar mortgage market. With bond market volatility priced so low, the combination of this quasi-easing, unresolved questions about the Fed's own mortgage holdings, and looming events such as the Supreme Court decision on tariffs means allocators may want to focus on how quickly rate markets could move if the current range breaks. Credit markets are echoing the common rates, but with their own nuances. Spreads between lower and higher quality investment-grade bonds are historically tight, and liquidity remains ample, which allows portfolios to move up in quality at relatively little cost and yield. Despite recent fixed income gains, global bond markets are still seen as offering attractive carry and roll-down opportunities, particularly where curves are slightly steeper. At the same time, there's a clear expectation that defaults will rise from unusually low levels as the credit cycle normalizes, with more of that adjustment likely to show up in private credit, where structures are less transparent and sectors such as smaller, rate-sensitive businesses are already under pressure. One striking credit theme is the concentrated policy support for housing finance. The directive for Fannie Mae and Freddie Mac to purchase up to $200 billion of mortgage securities has already triggered sharp rallies in mortgage lenders and other housing-related equities, and it directly bolsters agency mortgage liquidity. Although the Fed is still allowing its own mortgage holdings to run off, the increased participation from the housing agencies and the Treasury's active role are cushioning spreads and helping to stabilize or even lower borrowing costs for homeowners. Looking ahead, the key questions for credit allocators are how spread levels will react if front-end rates reprice or fiscal concerns push term premia higher, and how quickly any pickup in corporate and private credit defaults filters in a broader risk appetite. In foreign exchange, the U.S. dollar has regained some momentum, supported by higher Treasury yields and the perception that the Fed may keep policy relatively tight given resilient growth. The greenback has climbed to roughly a one-month high, reflecting this higher for longer narrative and ongoing investor preference for U.S. assets and deep capital markets, even as long-term fiscal questions linger. At the same time, Emerging market debt in countries such as Brazil, Mexico, and South Africa is attracting interest because of steep local curves and very high real yields, making those markets a focal point for investors who are willing to combine rate views with selective currency risk. The hedging conversation in FX increasingly overlaps with gold and digital assets. Flows into gold ETFs, such as GLD, have picked up as some investors question Bitcoin's reliability as a hedge, even as Bitcoin itself has regained momentum, posting its first back-to-back weekly gains in months and trading above $91,000. Institutional engagement is deepening, with large asset managers filing for spot Bitcoin, Ether, and Solana ETFs, and the successful launch of SpotX RP product signaling broadening appetite beyond the largest tokens. Stablecoin transactions reached around $33 trillion last year, and initiatives to tokenize money market funds suggest a more mature digital asset infrastructure that increasingly interacts with traditional currencies and funding markets. Despite this activity, overall FX and crypto volatility is subdued, mirroring the calm scene in equities and rates. Commentary stresses, however, that market sensitivity to U.S. rate expectations has increased and that just a couple of months of stronger inflation or jobs data could quickly shift sentiment, weighing on higher beta currencies, credit spreads, and risk-oriented digital assets. In addition, the pending Supreme Court ruling on tariffs and any subsequent policy response using alternative trade authorities has the potential to alter trade flows and introduce new winners and losers across the FX complex. For allocators, the mix of a firmer dollar, richer carry in select emerging markets, and growing but still untested digital hedging tools is a key area to watch as the macro narrative evolves. Commodities complete the picture, with oil, metals, and precious metals each telling a slightly different story. On the energy side, agreements to bring tens of millions of barrels of Venezuelan crude into the United States, coupled with plans for substantial U.S. investment to rebuild Venezuela's oil infrastructure, point to a gradual increase in supply under tight American oversight. Alongside strong domestic drilling and lower break-even costs for U.S. producers, this supports a base case of an oil market that is oversupplied by around 2 million barrels per day, consistent with forecasts for Brent in the mid-$50 range and WTI in the low 50s, and has helped push U.S. gasoline prices sharply lower. However, physical market signals complicate that apparently comfortable picture. Measures such as backwardation in crude curves, robust refinery margins, and strong demand for certain physical grades indicate that the perceived glut may be overstated. At the same time, speculative short positions in oil have reached record levels, while geopolitical risks, particularly tensions involving Iran and other key producers, remain elevated. That combination of heavy short positioning, resilient demand, and fragile geopolitics creates a setup where any supply disruption or policy surprise could trigger a sharp upside move in crude, with knock-on effects for inflation expectations and rate markets. Industrial metals are being pulled in a different direction. Copper prices have surged above $13,000, underlining the metal's strategic importance for electrification and AI-related infrastructure, and helping to drive deal speculation such as a potential tie-up between major miners that would greatly expand their copper exposure. Yet the reaction to that proposed merger has been mixed, with the buyers' stock up and the targets down, reflecting both optimism about copper and concerns about asset fit, regulatory scrutiny, and geopolitical sensitivities around strategic metals and coal. While some research houses now suggest copper prices may have peaked, partly on expectations of delayed tariffs as policymakers focus on affordability, industry players remain broadly bullish, making it harder to get large M and a deals done at valuations that both sides find acceptable. Precious metals tie the commodity story back to cross-asset hedging. Gold, silver, and platinum have all posted strong gains, and gold has reached new highs amid ongoing central bank buying that now exceeds 1,000 tons per year. Silver is in its fifth consecutive year of supply deficit, with consumption outstripping production by around 200 million ounces, a gap that is being widened by China's recent export restrictions on key materials. Many investors are turning to gold in part because they have less confidence in duration as a hedge, and because questions about the long-term role of the dollar and persistent fiscal deficits increase the appeal of holding a real asset that also responds to geopolitical stress, including risks linked to Iran, Russia, and Venezuela. For a diversified portfolio, the key is how these commodities signals cheap energy today, but fragility in oil, structurally tight industrial metals, and strong precious metal demand line up with the macro data and the evolving stance of monetary and fiscal policy. Stepping back across assets, we have an equity market buoyed by AI, banks, and housing policy, but leaning heavily on the assumption of a gentle Fed path and contained volatility. Rates appear remarkably stable in the face of mixed labor data, large deficits, and housing-specific easing, while credit spreads remain unusually tight even as defaults are expected to normalize from very low levels. In currencies and digital assets, a firmer dollar reflects higher for longer expectations, yet institutional adoption is drawing more capital into crypto and tokenized products. And commodities highlight both the disinflationary support of cheap oil and the persistent demand for copper, gold, and silver as strategic and defensive assets. For allocators, the main watch points now are incoming inflation and jobs data, any shift in Fed communication, the outcome and follow-through from tariff-related court decisions, and the implementation of energy and housing policy that could reshape curves and sector leadership. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.